Financial markets have been a complete bloodbath in the last few days. Volatility is through the roof. Institutional and retail traders are stuck and panicking. But listen up, this is not the time for you to freeze. This is not the time for you to be the deer in the headlights. Instead, this is the time for you to learn and adapt and understand that as a successful trader, you need to be able to evolve and perform really well across all market environments. In this video, I will give you the right guidance, trading strategies, and mindset to be able to successfully manage this market regime change. Stay with me till the end because I'm gonna give you some actual tradable themes with actual trade ideas and a list of things that you need to keep top of mind in this new market environment. Let's get into it. We're recording this presentation on the 7th of March, just before the payrolls data is released in the US. On the agenda today, we'll discuss the main drivers of financial markets recently. We'll also list a few things that you need to keep top of mind for the next few weeks. Also, most importantly, we'll discuss how to adjust your trading strategy for a high volatility market environment. This is very, very important. It makes the whole difference. Finally, we'll discuss some actionable themes that can be traded right away with actual trade ideas that you can put in your portfolio. Before we get into it, this is not financial advice and everything is purely for educational basis. Do read the disclaimer. Also, all the material presented here is owned and copyrighted by the Financial Traders Hub. So, what are the main drivers of financial markets? So, the markets ended 2024 and started 2025 quite bullishly. There was a lot of optimism from Trump's election, and rightly so, right? Market participants really wanted to believe. Price had rallied way ahead of fundamentals and expecting the latter to play catch up over the next few months. However, what's happening on the reality front? Inflation is still not yet under control. Leading indicators are hinting at a resurgence in inflationary pressures. The consumer sentiment is also falling. Most importantly, there was a big jump in the consumers' expectations of inflation over the next 1 year. The ISM new orders were released this week and they pointed back to contraction. Import tariffs are the talk of the town. The US is putting import tariffs on its main trading counterparts. However, those guys are also putting retaliatory tariffs on the US. This is a significant departure from the status quo in global trade. We are also seeing a growth slowdown being priced into financial markets, hence the sell-off. The US is also clamping down on deficit spending. These are all the things that are happening that the market are currently acutely aware of. Let's look at the Magnificent Seven. The Magnificent Seven led the rally of the S&P and the Nasdaq 100 to the top, and now they are the one leading the sell-off. The Magnificent Seven have literally broken down. So, what are the things to keep focusing on? The ISM PMI and ISM services are both hinting at higher prices. If at the manufacturer's end prices are increasing, it's just a matter of time before consumers also feel the inflationary pressures. These costs will be passed on to the US consumers. Crude oil price is also falling in line with the growth slowdown that's being priced in. Is it enough to keep inflation at bay? We'll see. Non-farm payrolls will also tell us about the strength of the labor market. That's scheduled to be out in a couple of hours. The Fed is also probably not close to cutting. Interest rates are still a headwind for some time. The Fed could also find itself stuck with an environment where inflation is high and GDP growth is slowing. This is known as stagflation. It's not a good environment for risk assets like equities. If the Fed has to cut, this is likely because demand is falling, and this is bearish for equities. There has been some capital rotation in the last few weeks. We've been covering this every week in our webinar, but as we can see in the last week, Capital has moved purely to defensive sectors like healthcare, consumer staples, materials, and capital has been flowing out of highly cyclical sectors like energy, consumer discretionary, and there's also been a lot of capital flows out of tech. The high volatility environment is here to stay, according to me. We've seen the VIX go up to 24.8. I think it could stay here for quite some time and even go higher. We've also seen the MOVE index, which is basically measuring the volatility of US Treasury bonds, go quite high in the last few weeks. So, how do you adapt your trading strategy for a high volatility market environment? As we've discussed, we believe volatility could be here to stay for a prolonged period. At high volatility, we are literally in a trader's market. What does it mean? It means you should expect these to happen. Changes in fundamentals will get priced in much quicker, so expect moves to happen on shorter time frames. Also, portfolio managers are now going to strictly underwrite holdings. They will reduce exposures and leverage. Also, anything that they buy in this market environment will tend to be high quality assets. So all your low quality, medium quality assets will not necessarily get a bid and the price will stay depressed for longer. Portfolio managers will definitely shun away from buying low quality stocks where a lot of benefit of doubt is required. As an example, in a low volatility environment, especially when growth is holding up, portfolio managers are able to give a lot of benefit of doubt to companies and situations that are not necessarily doing well or going to do well for the next couple of quarters, and they can look out to the future a lot longer. So for instance, if you have a company that's experiencing some short-term disruptions for a couple of quarters, portfolio managers will not necessarily care much about it and they will keep buying these types of companies, looking out 12 to 24 months ahead. However, now as we've discussed, there's going to be a preference for high quality stocks where there's a lot of visibility on the future cash flows. Also, expect short squeezes that will create a lot of fake rallies. So we've seen this week. I think it was on Wednesday, where the market closed up and then the next day the market just gave back all the gains and traded even lower. So expect these short squeezes because a lot of shorts are going to get involved, and in a high volatility environment you'll tend to see a lot of whipsaw action, right? So be clever, be adaptable, be strategic and be tactical in the way you start trading. Avoid the bull traps and make sure that you use these fake rallies to your advantage. It always comes down to fundamentals, guys. If you've done your fundamental work on a company or situation and have a bearish bias, but the price action is going up for a couple of days, I think you should use this to your advantage to get a much better entry price for your shorts. This is literally going to make the massive difference to your trading and to the returns that you're able to make. Also, be very careful to take profits as they come. In this type of environment, it's not worth staring at unrealized P&L. Book the profits, make it into realized P&L. If you want to have another trade, go back in. But make sure to keep booking profits as they come. At the same time, as more data comes and the fundamental picture becomes a lot clearer, make sure to adjust the portfolio bias. This is very important. You need to make sure that you're always in sync with the market. Do not be dogmatic. Do not think that the market is going to crash and bet all your chips on a market crash. No one really knows where this is going to end. So make sure that you're aware of all the fundamental information that you need to keep in mind. Stay flexible in your thought process. Stay diversified in your portfolio. Always have longs and shorts. And make sure that you don't have a significant bias in your portfolio. And make sure that you don't have a crazy bias in your portfolio. That is, let's say you're net short 100% or net long 100%. That's not going to work. You're just going to lose a lot of money. Now let's get down to some actionable, tradable themes. I can see that the market is starting to price in higher credit risk, especially at the lower end. We've seen a sell-off in subprime lenders like Capital One Financial, COF, auto lenders, Ali Bank and CarMax, and credit card providers like Symphony Financial, SYF. What I think is happening is that the market is now pricing in a higher delinquency scenario. Also, if retail spending slows down, new loans activity will grow at a slower pace, especially in the highly discretionary segment like autos, recreational vehicles, and so on. We're also seeing a sell-off in regional banks. What's happening there is the market is pricing in a compression in net interest margin and also factoring in the business slowdown that will cause a reduction in their fee income. Even there, the market is starting to price in a higher delinquency risk. How do I know this? Well, look at this. This is basically the credit risk premium that the corporate bonds in the US are pricing in. As we can see, it hasn't been an issue for the longest of time, but now in the last few weeks, we are starting to see that credit risk premium creep up, especially at the lower end, low quality end of the market. These are some notable charts that I'd like you to stay on top of, because as we're discussing an increasing delinquency environment, we need to understand exactly what's the whole backdrop and how bad things can get, right? We're looking predominantly at the LTV, so the loan to value ratios for new and used cars. So this is basically for loans that have been dispersed between Q4 2019 to Q4 2024. As you can see, there is a big problem brewing in the used car segment because these loans have been given at very elevated LTV ratios. I mean, LTV ratios going all the way up to 127%. That's literally crazy. In our latest weekly webinar, I discussed why this is a problem. This is a problem because these guys who have taken out the loan have literally no equity and even negative equity in their vehicles. So the moment their job situation changes or their financial situation changes, the incentive to default on the loan goes much higher. The other problem is that the banks or the lenders will find it very difficult to restructure or to negotiate anything with these guys because the asset that they are holding has negative equity, so there's zero incentive for them to pay back the loans. Also, what we're seeing here is that the quality of the loans dispersed from Q1 2022 all the way to Q1 2024 have not necessarily been of the highest quality. Actually, there is a big difference between the quality of loans here compared to previous cohorts, right? If you just look at these lines over here, right? These are the latest vintages, and they are already showing meaningfully higher delinquency ratios. We're looking at the delinquency ratio as the percentage of accounts that have been delinquent for more than 60 days. So that's a problem that's been brewing, and I think it's going to get even worse as we go along. Again, this is also illustrated with this chart here where we are looking at the account delinquency rate for accounts that are delinquent for more than 60 days. And we see that this ratio has been creeping up, and now they've also gone above the 2019 delinquency ratio. So we are in a situation where the job market is supposedly still strong. I mean, we'll see in a couple of hours as we get the jobs data. So we are in that situation where job hasn't even worsened and delinquency rates are already at significant highs. So what will happen if the job market weakens from here? It's just going to be a massive problem for a lot of these lenders. Another actionable theme, now more on the long end, just to be a bit more positive, a bit more optimistic, and also a bit more balanced in the portfolio. I think there is a lot of opportunity for local US manufacturing, especially as overseas sourcing is going to be impacted by tariffs. A few value chains that we can look into would be aluminum, steel, lumber, and also automation within industrial processes. So remember, this whole manufacturing, coming back to the US theme, right? The onshoring of manufacturing is going to require a lot of investment, a lot of rethinking, and also new factories have the opportunity to leapfrog technology by making use of increased robotics and any new form of automation. Think about it. At the end of the day, it's all about efficiency. If you're able to manufacture very efficiently, then you become very competitive on a global basis too. The ISM PMI and ISM services are still pointing towards growth, although at a slower pace. I believe there are great opportunities within a lot of industries for both longs and shorts. So at the moment, the dispersion that you have in the market is the best that I've seen in a long time. And this is a fantastic place for long and short portfolio managers or traders in this volatile environment. Also, I believe there are a few opportunities within the tech software companies, and these could rally hard once the correction is over, especially if the Fed starts hinting that they are going to become more dovish and cut interest rates. Make sure that you pick the high quality assets and stay away from a lot of these fluffy tech companies with lofty valuations, crazy fundamentals, very elevated stock-based compensation levels, and so on and so forth. I've got a few names here in GitLab, Pinterest, and BlackBerry. Of course, before you go and put it in your portfolio, do your own work, make sure that you've done your own due diligence. But I quite like GitLab. GitLab is a big beneficiary in this whole AI software move. Pinterest, that's a tricky one because if the economy folds, then it's not going to be a good long. But if the economic growth holds up, I think Pinterest has a big chance of re-rating upwards from here. BlackBerry, that's a company that's been flying under the radar, almost undergoing a little bit of turnaround within the business. We started looking at it when it was trading at $2 in November, December, and now it's trading much higher, probably closer to $4 or $5. Maybe it's corrected a little bit. So make sure that you do your research on these names, and there are many, many more names in tech that are high quality that could easily give you 15, 20, 30% upside once this correction is over. So this is it from me, guys. You need to be strategic, adaptable, and level-headed in these type of market environments. Also, use this as a massive opportunity to learn how to trade financial markets properly. These times don't come very often, and when they do, don't panic. Just use it to learn and adapt and get even better. There are a lot of opportunities, and as you know, traders thrive with volatility. So make sure that you're also taking advantage of these new market conditions. Now, if you've gotten value from this video, hit subscribe, like the video, and also maybe share it with your friends who are also struggling in this difficult market environment, right? We're all here to learn and to help each other. If you want to learn more about trading financial markets profitably and consistently, join the Financial Traders Hub. We have a Discord server where we discuss trade ideas in real time. We also do a weekly webinar to keep people abreast of whatever's happening in the market and give them a little bit of a market breakdown. And most importantly, we have a community of like-minded members who are all here to learn and understand how to trade financial markets very proficiently. The link to join the Financial Traders Hub is in the description. It's free. Feel free to subscribe. We also did a Watchlist Building Workshop at the start of Q1 where we've discussed every single thing that has happened in markets so far. So if you want to get access to that, the link is also in the description below. You'll absolutely love it. This would allow you to understand how to generate trade ideas, how to think about themes, how to think about macros, how to think about valuation, how to think about individual industries and companies. It's a 4-day workshop that probably lasted for 5 hours per day. There's a lot of incredible content in there. I'm sure this will fast track your understanding of financial markets and significantly improve your trading skills. With that, I'll see you in the next video. Good luck out there. Stay sharp, trade smart, and make a lot of money for yourself.